Today, we're breaking down a key tool for global investors, the ICPM. Let's get right into it.
So if you're investing internationally, there's way more to it than just standard market risk. To really get this, we have to start with its foundation, the classic capital asset pricing model.
CAPM is a great starting point, but, well, it's built for a world that isn't exactly real.
See, the model makes some pretty big assumptions, and honestly, they just don't hold up out here. And its biggest flaw for global investors? It thinks there's only one single market. Big problem. And that brings us to the missing piece of the puzzle, currency risk. It's a huge deal. So here's the evolution. ICAPM takes the original model and adds that all-important currency risk. The beauty is, ICAPM doesn't start from scratch. It builds right on top of the CAPM formula. And then it adds a new piece to account for currency. This is where it goes global. Think of it as hazard pay, the extra return you demand for dealing with unpredictable exchange rates. This covers it all. For instance, a U.S. company's costs changing because it buys parts from China. Okay, but like any model, ICAPM has its own fine print. There's one critical assumption here. It assumes that international markets are totally integrated. Similar risk should mean a similar price, right? But if markets aren't integrated, you get these weird pricing gaps, and that creates opportunities.
All right, let's make this real. Imagine we've got two different Japanese companies.
Company A is all in on Japan, but Company B, it earns in US dollars and its costs are in yen.
So, what happens if the US dollar suddenly gets weaker compared to the Japanese yen? Well, Company B gets slammed. Its dollar profits just don't cover its yen costs as well anymore. So you, as an investor, would demand a much higher return from Company B to cover that extra risk.
So why should you care about any of this? Well, it can actually help you find an edge in the market.
It's about finding that alpha by spotting where the market might be getting currency risk all wrong. So let's wrap this up. ICAPM takes a classic model and makes it work for a modern global world. Because in today's world, ignoring currency risk, that's a risk you really can't afford to take.